The 50-year mortgage is already dead. Most people covering this story don't know that yet, and the part they're missing is actually the most interesting part of all of this. THFA Director Bill Pulte said the White House is moving away from his 50-year mortgage proposal, saying the administration now has other priorities. That's a strange sentence when you think about it. 2 months earlier, Pulte had described it as a complete game changer, and now it's just gone. So the question isn't whether you should be afraid of the 50-year mortgage. The question is, why did it collapse so fast? What does the math actually say? And what are the real solutions nobody is talking about? Because there are some, and they're already working. Here's what we're going to cover. The exact math of the 50-year mortgage in dollar terms. Numbers most coverage never actually runs. The political story behind why this thing fell apart faster than almost any housing proposal in recent memory. What Japan's experiment with ultra-long mortgages actually proved. And then part of this story, I think, is genuinely underreported. The supply-side reforms that are quietly changing what housing costs to build, right now, in real states with real laws. I've spent a lot of time on the housing data on this, and the thing that keeps coming up is that the conversation about housing affordability is almost always framed around how to help you afford the price, and almost never about why the price is what it is in the first place. That framing matters. And I'll come back to it at the end, because there's one detail about what's actually happening at the state level that changes how you think about all of this. Let's start with the second most important thing in this story. The math. A $300,000 home, 5% down, 5% interest rate. On a 15-year fixed, you're paying $2,254 a month. On a 30-year fixed, that drops to $1,530. And on the proposed 50-year mortgage, it drops to $1,294. So the difference between a 30-year and a 50-year mortgage is $236 a month. That's the number they were selling. What they weren't leading with is what you're buying with that $236. You're buying 20 extra years of debt, 2 full additional decades of payments, and a dramatically slower path to actually owning the thing. The equity you'd normally be building in years 30 through 50 is instead going to interest. So the savings aren't really savings. They're a loan on your future, dressed up as relief. And here's where the story gets politically strange, because the backlash didn't come from the usual corners. The idea sparked considerable backlash among economists and industry insiders, who said that such a move would have significantly increased debt levels. That's expected. But Fox News' Laura Ingraham told Trump the proposal had enraged your MAGA friends, citing significant backlash and calling it a giveaway to the banks and simply prolonging the time it would take for Americans to own a home outright. That's a rare moment. The political script usually runs left versus right on housing. This one broke differently, and inside the White House, it was even messier. White House officials were reportedly furious with the idea. National Association of Realtors chief economist Lawrence Yun added that longer-dated mortgages wouldn't address the true cause of today's affordability challenges. So within about 2 months, Pulte said that the proposal had been put aside by the White House. The proposal, which was panned by officials in the White House as well as industry experts, will not be among the actions in Trump's executive order. Now, the Economist's objection to this proposal is worth understanding, because it's not just debt is bad. The mechanism is more specific than that. Increasing demand for homes through the 50-year proposal would only make the situation worse, because more flexible financing is essentially a subsidy for housing demand. It adds to the pool and buying power of buyers without increasing the supply of homes, which drives prices up. The savings get eaten by the market before they ever reach you. You stretch your loan, sellers raise their ask, and you end up in the same place you started, except now you're paying for 50 years instead of 30. And this is where I want to bring up the thing almost nobody is mentioning in this conversation, because it's the most important data point in the whole story. Japan already ran this experiment, and not just a 50-year version. They ran a 100-year version. A recent innovation in Japanese real estate was the creation of a 100-year mortgage term, where the home becomes an ancestral property passed from grandparent to grandchild across generations. And a rigorous academic analysis found the 100-year mortgage failed to increase the affordability of homes. Instead, affluent homeowners were more likely to use long-term mortgages as an estate planning tool to reduce inheritance taxes. The ultra-long mortgage didn't help ordinary families buy homes. It became a tax strategy for people who already had money, and the historical echo is genuinely eerie. As Japan's real estate bubble progressed in the late 1980s, lender expectations loosened, and 100-year, three-generation mortgages appeared. Grandkids were paying off their grandparents' mortgage. Japan's bubble then burst in the early 1990s, with property prices falling 60 to 80% in Tokyo, leading to what economists call the lost decade. And right now, in the middle of a new affordability crisis, young Japanese people are once again opting for 50-year loans. The exact same instrument, resurfacing in the exact same country, during a new version of the same problem. That's not a coincidence. That's a pattern. And here's the thing I keep coming back to, the one that pulls all of this together. Every solution we've talked about so far is trying to help you afford a price that is already inflated. Nobody is asking why the price is inflated in the first place. And that's where the real story is. I'll get to it in a second, and it's going to reframe how you think about all of this. But first, the 50-year mortgage also isn't even a new idea. It's actually a bigger version of something that already failed quietly. As one expert put it, the proposal will have no legs because they've tried to do a 40-year term that has not taken off, referring to 40-year mortgage modifications that were offered in earlier attempts to help struggling homeowners. So this wasn't a bold new idea. It was a supersized version of something that already fizzled once before, and somehow nobody mentioned that. Now here's the part of the story I think actually matters, and the part that almost never makes it into housing coverage. In 1860, a fatal tenement fire led to a two-staircase mandate in New York, and made the external metal fire escape a fixture nationwide for more than a century. That single 19th century rule is still baked into most modern building codes across the country. Every mid-rise apartment building you see being built today is required to have two staircases, not because modern fire science demands it, but because of a rule written in response to a disaster that happened 165 years ago, before sprinklers existed, before fire-resistant materials existed, before any of the things that actually make modern buildings safe existed. Seattle challenged this norm in the 1970s when it legalized single-staircase buildings of up to 6 stories with modern fire safety requirements, like sprinklers and fire-resistant construction materials. And it's been working there for 50 years. A report from Pew Charitable Trust shows that single-stairway buildings as tall as 6 stories do not put residents at greater risk and are as safe as other types of housing. The data spanning from 2012 to 2024 reveals that fire-related fatalities in modern 4- to 6-story apartment buildings in New York City remained consistent with other residential structures. And during that same 12-year period, there was not a single recorded death where the lack of a second exit was a contributing factor. So the safety argument for keeping the old rule doesn't hold up to the data. What does hold up is the cost argument for changing it. A single stairway 4- to 6-unit building could cost between 6 and 13% less than a similar dual stairway building, which translates directly to unit affordability. It costs roughly $200,000 to construct a second staircase for a mid-rise apartment building. That's $200,000 per building. That comes directly out of what it costs to build housing, which comes directly out of what housing costs to rent or buy. And here's what's actually happening right now with this. Since 2022, 19 states and Washington, D.C. have introduced bills to study or allow the construction of single stairway buildings. And in 2025 alone, 7 states passed and signed bipartisan legislation. Colorado, Montana, New Hampshire, and Texas now allow them, with Hawaii and Maryland convening groups to study the reform. This is quietly one of the biggest supply-side housing wins in the country, and it almost never makes it into the conversation about the housing crisis. And then there's Indiana, which just did something even more direct. Indiana's HB 1001 makes single-family homes, duplexes, in-home accessory dwelling units, and certain affordable housing projects permitted uses without a public hearing. It caps parking requirements, prohibits regulation of residential design elements, and restricts lot size, density, setback, and bulk standards on certain parcels. What that means in plain terms is that the law removes the local bureaucratic friction that makes it expensive and slow to build housing in the first place. That's the literal opposite of a 50-year mortgage. Instead of stretching your debt to match inflated prices, it attacks the reason prices are inflated in the first place. That distinction is the whole point of this video. One approach says, housing is expensive, so let's help you pay for it over a longer period of time. The other says, housing is expensive because we've made it structurally difficult to build, so let's fix that. One of those approaches helps you carry the weight. The other tries to put the weight down. If you want to go deeper on all of this, the full breakdown of the 50-year mortgage math, the state-by-state reform tracker, and a plain language guide to what the supply-side changes actually mean for buyers and renters. I put it all together in a PDF guide you can grab in the link below. It's the kind of resource I wish existed when I started digging into this, because the housing conversation moves fast, and most of the useful detail gets buried. And it'll give you a much clearer picture of where things are actually headed. Here's where we landed. The 50-year mortgage was floated, got crushed from every direction, economists, the White House's own staff, and politically from people you wouldn't expect, and was quietly shelved in about 2 months. The math never worked. $236 a month in exchange for 20 extra years of debt, and a market that would have absorbed the savings anyway. Japan proved it with a 100-year version, and it became a tax tool for the wealthy, not a lifeline for regular buyers. And a smaller version of this idea already failed once before, which almost nobody mentioned. But the real story is what's actually working. A 165-year-old fire rule is finally being updated across the country, and it's cutting construction costs by up to 13% per building. States are removing the zoning friction that inflates prices before a single brick gets laid. The supply side is moving, and it's moving faster than most people realize. The 50-year mortgage was never going to fix the housing market. It was going to make it more expensive and hand you a longer bill for the privilege. The actual solutions are less dramatic, harder to fit in a headline, and already in motion. That's usually how the real stuff works.